COO, CFO role at various startups from as low as 10 up to 400 over the last 10 to 12 years, usually doing finance or ops roles. Similar to Gotham, so I've worked in media, I've worked in SaaS, I've worked in cloud computing, and I've worked in a few advertising and a few others. Similar to Gotham, many times had to do headcount reductions, had to scrimp and save to hit next month's payroll. One of my companies, 6 months, we only had 3 weeks of payroll, 3 weeks of runway. So very familiar with saving money to kind of stretch out and lower burn. Mostly have done venture-backed startups, but I've also done profitable as well. So should I just dig into the questions or?
Yeah, actually, Brian, that's super helpful. Why don't we start the first question? I can see people are putting questions into the box, but I want to just kind of open it up. The question that I'm getting pretty much daily from entrepreneurs and friends of mine is, how do you plan for 2020, given how much has changed and just given how much uncertainty there is in the rest of the year?
Yeah, so no question, cash is king, runway is king. 24 months of runway is what people are going to want to look at. If you're not getting yourself to Christmas of 2022, I would recommend trying to find a plan that gets you there. So if you can, I would make some very pessimistic assumptions about revenue and then start to talk about what your monthly burn would have to be to get you to 24 months, what your monthly burn is now, and then start thinking about the cuts that come between now and then. So that doesn't necessarily mean you have to make those cuts. That doesn't necessarily mean that that's going to happen to your revenue, but you need to have that concept in your mind and start getting ready to have a prioritized list of the cuts that you would make and sort of agreement with the stakeholders in your board, stakeholders with your executive team, about what that prioritized list might look like. Gartner's done a poll of various CFOs and talked about some of the cost reductions that they would make. So, everything from freezing hiring, freezing T&E spend, canceling conferences, delaying CapEx investments, delaying new hire offers, and then, all the way down to potentially doing layoffs, rescinding graduate offers and things like that. So there's a range of things. Definitely the most popular thing so far has been, let's freeze hiring, let's freeze T&E spend, let's take a very hard look at the marketing spend that we have, and line those up. But basically what I would recommend is, this would be a lot better with a screen share, but make a table. On the top is revenue, expense, working capital, equity, and debt, and then make a list of the different levers of each of those. So, let's assume that, hey, we're going to have a 50% reduction in new customers. We're going to have our churn increase to 10%. We're maybe going to have our COGS increase. So take all of your sort of negative things on the revenue side and add them up. And then on the expense side, think about just brainstorm a kind of a long list of things you could do on the expense side. Reduce headcount, give people 50% of their bonuses, cancel your co-working contracts, cut T&E. Just make an estimate of what impact that would make on your monthly burn, and make a kind of a long list. And then the same thing on the working capital side. Let's see which suppliers we can pay net 60. Let's assume that bad debt is going to increase, by 8% or something like that. Let's assume that we can renegotiate with certain vendors to improve things. And then on the equity debt side, you could imagine, let's expand the venture debt line. Let's raise a bridge round, sooner, things like that. Basically kind of total all those things up on a monthly burn basis, have that kind of long list handy. And then take that to your executive team, take it to your board and say, hey, here's the options that are in front of us. Let's talk about which of these we should prioritize first when we're thinking about revising the plan.
And so, Brian, on the working capital side of it, a lot of companies are considering venture debt, are looking for just ways to extend runway. What have you been hearing specifically around venture debt? Is that a viable option at this point for companies?
Yeah, so the rumor on the street is that a lot of the venture debt banks, like Silicon Valley banks and Comerica, have sort of deprioritized taking on new customers, and they're really working on expanding facilities with their existing customer base. Same thing with the venture debt firms like WTI and TriplePoint. I've heard that they have been a little more reticent to extend new terms, so everyone's kind of coming to grip with the new reality. So it could be hard, frankly, to get more venture debt if you don't already have an existing relationship. The one exception I've heard is JP Morgan has a new venture lending arm and is starting to take more customers. But it never hurts to reach out, start forming that relationship. Right now, everyone's sort of buried in the Paycheck Protection Program lending. So all bankers everywhere are overwhelmed trying to process that. But that's probably going to kind of work itself out in the next couple of weeks. But for sure, venture debt is a very viable option if you get it. Unless you have less than 12 months of runway, I wouldn't immediately draw down the debt. You want to have that discipline. You don't want to have a false sense of a larger balance sheet security than you do have already. And so I would delay that as you can. But then, of course, also, do what you can to extend maturity dates of existing lines of credit, raise lines of credit, potentially talk to existing insiders about what a bridge round might look like, that kind of thing.
Yeah. And Brian, you talked about the PPP, so I want to go there next. But before we do that, I'm just going to remind everyone the Ask a Question button in the bottom of your screen will let you ask Brian any question that's on your mind. We will be watching and looking for those. But Brian, you mentioned the Paycheck Protection Program. That's something that many startups are thinking about, have questions around. How are you advising companies around PPP and some of the things to be things to consider, as it relates to making that application, the decision to apply, and then who to talk to if you do decide to apply?
Yeah, absolutely. So for those of you who aren't aware, so the Paycheck Protection Program was passed a couple of weeks ago as part of the CARES Act. It's $350 billion designed for small, medium businesses to basically not lay off people. So the intent of the legislation is for employees that are companies that are less than 500 employees who are very adversely affected by the current economic situation, and maybe their revenues have crashed, maybe whatever would cause them to do layoffs in the next 2-3 months, to not do those layoffs. So effectively, there are a few aspects of the program. Generally speaking, you have to have less than 500 employees, and that can trip some venture-backed startups up, and I'll tell you why in a second. The second is you'd have to have adverse economic circumstances that might make you lay off people. So if you were to, so basically what the program does is it gives you up to 2.5 times your payroll, your monthly payroll, up to $10 million with a salary cap of $100K per employee. And then it gives it to you as a loan, and essentially the loan will be forgiven in some period of time if you haven't laid off anyone during that period of time. So I don't know if people will just wait till July to do all their layoffs, but at least don't take the money and then proceed to do the layoffs anyway. The loan won't be forgiven. You'll still owe the loan. But there is a nuance for venture-backed startups, and the nuance is this. If you have any investors with more than 50% of your equity ownership in your business, you would be considered an affiliate of that business, and all of their employee base would also be counted against your 550 or your 500 employee limit. The other thing, though, is if you have the other threshold is 20%. So if you have owners with less than 20%, but negative covenants against your business, which effectively is like the ability to vote on your budget, the ability to hire and fire executives, the ability to take on debt or issue dividends. All those things would be considered to be a controlling covenant. And so even if they owe less than 20% of your equity, they could still be considered to be an owner, which means that a lot of companies will find them that are venture backed will find themselves pooled with all the employee base of all the other companies in the in your venture partners portfolio, and so you have to be pretty careful about it.
Cool.
Yeah.
And Brian, there's a question that kind of came in here that I'm just going to paraphrase and kind of expand on it. But are you seeing, and you know, I may chime in on this too, are you seeing the appetite to invest change across VC firms and angels? So, you know, I guess maybe the other way to phrase that question is, you know, what do you foresee going back to working capital? We talked about venture debt. What do you foresee as kind of the opportunities and challenges of raising equity capital over the next 3 months?
Yeah. So, you know, I lived through the dot-com downturn. I lived through the housing bust in 2008. Universally, everyone wants to take a breath, take stock of where things are, and be very cautious about taking on new relationships, new obligations. And so I think, you know, everyone from hiring to venture capital firms are going to do that. Definitely venture capital firms are working with their own portfolio companies very strongly right now. And so I think you're going to see definitely things slow down. Now that doesn't mean that deals won't get done, but the bar will be raised across the board on everything. But Gotham, this is really more your, so you should probably chime in on this.
No. I think that's totally right. I mean, I think there's definitely been a slowdown already, and I assume that is only going to continue. And so, you know, I think what you said is absolutely right. I am just going to read this next question here.
Actually, while you're reading that, let me throw in one more thing about the PPP program. So it just opened Friday. SVB just opened its application yesterday. The website's been crashed, but a very important thing to know about it is it is first come, first serve, which means that you know, that 350 billion could be exhausted. Some people are saying as early as late April. So I do recommend moving quickly if you want to participate. And the way to do that is to reach out to your existing lenders, existing bank relationships if you can.
Awesome. I'm also reading the very active chat that we have going on. Runway is the new cool look along with bootstrapping. So I couldn't agree more. So this question, we'll kind of end, Brian, on this question and then move to Matt. But Will asked us, as a self-funded venture builder studio that is not a VC model, what are some ways to raise funding for this type of model to allow us to support our entrepreneurs? And what would some of those typical sources of funding be? So, you know, M13 has a launch pad where we help incubate companies as well. And so, you know, maybe to make the question more broad, if we weren't a venture capital fund, you know, how would we be thinking about funding, you know, companies like those that are in the launchpad and other businesses who may have just different needs than your typical technology venture-backed company?
Yeah, I mean, you know, revenue is the best. You know, obviously, whatever you can do, get the revenue, get customers who will sign on in advance. I think the main thing is, you know, I think a lot of people are looking to, you know, be a little more conservative about taking on new projects, and so you should just assume that sales cycles will lengthen, fundraising cycles will lengthen, you know. Debt collection will lengthen. So everything's going to take a little longer and be a little harder for the foreseeable future. But I don't think that the rules of the game will have fundamentally changed. I think, you know, equity investors will still be equity investors. It'll just be a little harder to woo them. The bars will be higher. And, you know, to whatever extent you can keep your burn very low and rely on real revenue, you know, ideally you're selling customers and getting them to prepay some amount of money for, you know, a discount. That's the best thing, you know, in business as in life.